Investors in UiPath are set to have a pleasant end to the trading week, with shares up about 14% in early morning trading. What happened during this company's earnings report that has investors so excited? Here's everything you need to know in about 10 minutes. My name is Brian Feroldi. As of the time of this recording, I do not own shares of UiPath, but Brian Stoffel does. And thank you to YCharts for sponsoring today's video. Let's get right into the numbers. So this is the company's fiscal year Q3 of 2023. This is the period ending October 31st. The company's market cap, if you include the bounce this morning, is about $7.7 billion. Revenue grew 19% to $263 million, easily surpassing Wall Street's estimates and blowing past management's own guidance. On an earnings per share basis, 5 cents on a non-GAAP basis versus flat year ago period, also besting Wall Street's estimates. So the headline numbers here looked good. Getting into revenue more closely, licensing revenue grew 6%. This is the revenue that we actually want to see starting to fade away over time. It did grow 6% and contributed nicely to the total revenue growth. Subscription revenue, this is the revenue we actually care about the most as investors, grew 33%. Nice to see that. Professional services and other revenue, we don't really care about that as investors, growing 28%, but hence why total revenue did grow. Total customers now using UiPath's platform grew 11% to 10,650. Decent number there. The number of customers that are going to spend at least $100,000 in annualized recurring revenue grew 26%, and those that are spending at least $1 million grew 49%. So the company is successfully landing bigger and bigger clients and moving those to spend more. That is a positive sign for investors. Now, the dollar-based net revenue retention rate, an important number for any SaaS investor to look at, 126%, very strong result. And if you exclude foreign exchange impacts and Russia's sanctions, the number would have been 130%. That is very, very impressive number. Another number to look at is the gross retention rate. This is just including churn. This does not include upsells. 98%. That is an outstanding number and shows just how sticky this platform is. Turning to margins, gross margin for the period actually expanded to 86.3%. Very impressive result there on a non-GAAP basis. Operating margin was positive 7%. Net margin plus 10%. Some wonky things going on there, and these are all non-GAAP numbers. On a free cash flow basis, though, negative $33 million in free cash flow for the period. Weak on a free cash flow basis. The company prepaid for a bunch of expenses. That kind of explains that. Net income on a non-GAAP basis was positive $27 million, and the balance sheet, $1.7 billion in cash, zero debt. So the free cash flow, the negative free cash flow, is worth watching, but minuscule when compared to the company's balance sheet. Remaining performance obligations grew 40% year over year, a very strong number. Really nice to see that is growing so well. Stock-based compensation expense actually is down substantially year over year, still pretty high at $270 million. That's about 27% of revenue. So a very high number, but you can see down sharply versus the year ago period. So let's hope that trend continues. Turning to expenses, I'm looking at expenses on a non-GAAP basis. On a GAAP basis, they were down down year over year, mostly due to the lower stock-based compensation. On a non-GAAP basis, up across the board. So higher spending on sales and marketing, higher spending on research and development, higher spending on general administrative. On a GAAP basis, again, they were down year over year, but these are the numbers I more am focused on and care about. So the company does continue to invest in itself. Turning to dilution, the dilution rate year over year was about 3.4%, the share count up a bit. That is in my category where I do ding companies for diluting investors too much, but there are worse diluters out there. Turning to annualized recurring revenue, this figure continues to grow. While it has grown at a 51% growth rate over the last couple of years, it has slowed down a little bit recently, still pretty good in overall terms. Turning to guidance for the upcoming quarter, management raised its expected annualized recurring revenue range to $1.174 billion. That is up about $200 million from its prior range. And getting into revenue guidance for the next quarter, management is expecting about $278 million in revenue. While that is a 4% drop year over year, that is beating Wall Street's estimate. Management does not give earnings per share guidance. Wall Street is expecting about a nickel in adjusted earnings per share. For the full year, revenue guidance is about 15% to about $1,028 million. That is ahead of what Wall Street was expecting. Again, management does not guide for earnings per share guidance. Wall Street is expecting a 2 cents loss on the bottom line. I have a feeling that's going to go just about towards break even this year. So what should investors watch moving forward? It's the same things we suggested last quarter. Keep an eye on subscription revenue. That is the revenue growth that we really care about as investors. 2, keep an eye on remaining performance obligations. We want to see that growth continue, indicating that demand remains strong. 3rd, keep an eye on dollar-based net revenue retention rate and gross retention. That indicates that the company's customers are using the platform and spending more over time. And 4th, keep an eye on free cash flow. Free cash flow is currently negative. Hopefully that turns positive in the not too distant future and continues to grow thereafter. Overall, after judging this company's results, can't help but think that the moat here is stable, perhaps even widening, and that the thesis for owning this stock is fully on track. We ran this company through our investing frameworks. It scores in the investable category on mine. There is some upside here, especially if the company starts cranking out positive free cash flow growth. That could be a pretty big bump on my score. On the anti-fragile score, it's in Brian Stoffel's robust category. Again, it could move up here with positive free cash flow production. Turning to valuation, where is UiPath on this growth curve? The answer is somewhere between stage 2 and stage 3. The company is not yet focused fully on profit yet and is still trying to grow its revenue very rapidly. When we think through the company's income statement, it's currently optimized for revenue and gross profit, and even revenue is a kind of a question mark. The company's revenue growth is declining year over year. That is mostly due to the SaaS transition. We have a video that explains that in more detail. If you're interested in watching that, I do leave a link at the end of this video. But with that in mind, let's take a look at the price to sales ratio and the price to gross profit ratio, which are the only tools that we have to look at valuation right now. And we're going to do so by using the sponsor of today's video, which is YCharts. Now, one thing that YCharts is doing for our member is they are giving our viewers 100 of our viewers will get free access to the professional platform until December 16th. There is a link in the show notes if you're interested in signing up. YCharts is a very, very powerful tool that we use in almost every single video that we do. So if you're interested in giving it a try, check out the link in the video description. But let's take a look at the company's valuation metrics. So on a price to sales ratio, you can see that this company, when it came public, was trading at, 66 times sales. Huge, huge number. And this figure has fallen all the way to about 7. You can add another, 12% or so today. So that gets us to about 7.7 times sales. Take a look at the market cap. The market cap, again, is about 7.7 billion. Compare that to the trailing 12 months gross profit. This figure is about 850 million or so. So divide those two numbers together, you get a number of about 9 times gross profit. So 7-ish times sales, 9 times gross profit. Neither of the numbers are cheap in absolute terms, but they could indicate that there is some value here moving forward. It's also worth noting that the price to sales ratio, the revenue is under pressure right now as the company continues to transition away towards its SaaS model. So that is something that could indicate that. One other thing that's worth noting, the decline in the share price is, of course, no fun for investors that have held on so long, but the company is very close to being self-funding at this point. That is because the company is nearly producing positive free cash flow. It could if it really tried to focus on that. So the downturn in the stock price is not a big threat to this company. It's not a big opportunity either because the company is not yet fully self-funding, but the downturn in the share price is not something too concerning for the business to worry about. I hope that you found this review to be useful. If so, please let us know in the comment section below and give this video a like. It does help us get discovered by more investors who are interested in our content. Let us know what other stocks you're interested in us covering this earnings season as it does come to a close, and see you in 90 days on this one. Hope this was useful. Brian, out.